Hi everybody, I'm Dave Van Knapp. Greg Patrick has talked me into trying my hand at videos, and this is my first one. I hope you like it. A word about my background. I am retired from a career in publishing since 2001. I've been a dividend growth investor since 2008. DG stocks are the only kind of stocks that I own. I've become an expert in the subject, and that's what my videos are going to be about, dividend growth investing. Sometimes I'll talk about particular stocks. Other times I'll talk about my dividend growth portfolio and what's happening there. I also have a set of DG lessons, and over time we're going to get those on video too. If you like this content, please click the like button and also consider subscribing to the Dividends and Income channel. That'll help us out. Okay, let's get started. This video is about a particular very good dividend growth stock, which you've undoubtedly heard of. It's Pfizer. Ticker symbol is PFE. Pfizer is a biopharmaceutical company. That means that it discovers, develops, and manufactures medicines and vaccines. Pfizer also is a producer of pharmaceuticals and biotech drugs that are sold around the world. Pfizer is what I call my dividend growth stock of the month for March 2021. And whenever I talk about a dividend growth stock of the month, I will always start by talking about Pfizer's or the company's dividend record. This is Pfizer's dividend record. I want to call your attention to a few things in it. First of all, the top line yield. Pfizer is yielding about 4.4% now, which I consider high yield. I consider anything 4% and above to be quote-unquote high yield. I know some others would call that a mid-range or even a low yield. But for me as a dividend growth investor, as opposed to a high yield investor, anything over 4% is high. Moving down the table a little bit in the middle, you can see that Pfizer's 5-year dividend growth rate has been 6% per year. That may sound modest, but for a high-yielding stock, that's really pretty good. One of the things you'll learn over time in dividend growth investing is that as you reach for higher yields, the dividend growth rate, meaning the annual rate of the company's increasing its own dividend, tends to go down, and that makes total sense, right? At the bottom of the table, you can see that the dividend safety score from Simply Safe Dividends is 75 out of 100, and that's in their, they use a 0 to 100 scale, and 75 is a high score. It's an above average score, and it indicates that Pfizer's dividend is quite safe. One other note about Pfizer's dividend is that its past few years' increases have been going down a little bit each year. Sometimes that's a concern for a company when you see a declining dividend growth rate. I don't consider it to be a big concern with Pfizer. They've been investing heavily, and they have the cash flow to cover their dividend easily. That's the main reason that they got the high dividend safety score from Simply Safe Dividends. In fact, Simply Safe Dividends has said that after they get through this year of dividend adjustments, they expect to keep Pfizer's score at 75, which is a high score. They made this announcement recently. Overall, given Pfizer's 4.4% yield and probable mid-single-digit growth rate, that's the kind of dividend growth stock that I would label high yield mid-growth. As you watch my videos over time, you will come to discover that I'll label every stock in that way. One adjective to describe its yield, low, medium, high, and another adjective to describe the rate of its dividend growth, low, mid-range, or fast. Now I want to talk to you a little bit about Pfizer's business. As we already know, Pfizer is a pharmaceutical company, one of the largest pharmaceutical companies in the world. And of course, Pfizer's been in the news over the last several months because it's the co-developer of probably the most widely distributed coronavirus vaccine. The vaccine is going to provide approximately a $15 billion increase in Pfizer's revenue this year. But that's kind of a one-shot deal, or maybe it's more accurate to say we don't know whether or not it's a one-shot deal because we don't know whether the virus is going to fade out or over what time period it's going to fade out. So that may be a continuing income stream. Anyway, for 2021, the vaccine becomes Pfizer's biggest product, but it takes its place among a wide range of products, some of which you've heard of, even if you don't take any of them. This graphic shows some of Pfizer's blockbuster drugs. In the pharmaceutical industry, blockbuster drug means a particular drug that draws in $1 billion or more per year in revenue. And as you look at that display, you can see some names that you've probably recognized from TV commercials. We see Prevnar, we see Xeljanz, and we see Eliquis, and I know I've seen commercials on all of those. This is my business quality summary for Pfizer. I get ratings of quality from third-party sources that I've worked with for years and I've come to know and trust. As we go down, if you look down the right side, interpretation, you can see all of the individual indicators are green, either dark green or light green. Green is always good in my tables. The one at the very top I want to speak about for just a minute. The Morningstar moat rating. Morningstar gives Pfizer a wide moat rating. If you're familiar with the concept of moats in investing, it means it's similar to the moat around a castle. It's what provides protection. For Morningstar, giving something a wide moat rating means that they think that the business that they're rating is protected for a period of 20 years or more from significant deterioration from competition. In awarding that moat rating, Morningstar focuses on these factors. One, the company's patents. In the drug pharmaceutical world, patents are issued that protect a brand name drug for a period of time before it becomes subject to competition from generic versions of the exact same drug. Their moat is partly based on strong brand names. We mentioned a few of them before. Economies of scale. Pfizer is a huge company, and therefore it means it can see economies in procurement of raw materials and in the manufacturing of drugs. They get economies of scale simply from being so large. And finally, Pfizer has a powerful distribution network with direct sales reps out and about in the medical community selling their drugs. Next, we're going to talk a little bit about Pfizer's financials. I'll always refer to a company's financials just to give you some familiarity with the financial wherewithal of the company. Ultimately, we want to get to the point where we have confidence that the company will be paying out dividends regularly, meaning every quarter, and raising them regularly, meaning once a year increases. This graphic shows Pfizer's operating margin. Operating margin is a measure of profitability. And you can see the line across the graph saying above 12% is our preference for most companies. That graphic is from the site called Simply Safe Dividends, and they have created benchmarks for different kinds and different sizes of companies. And the reason I'm showing you this is because Pfizer's operating margins run 2 to 3 times higher than the benchmark that Simply Safe Dividends has for operating margins. Stated briefly and in plain English, Pfizer is a very profitable company. This graph shows Pfizer's earnings per share. As we can see, the earnings per share have been always positive. The company never loses money in a given year. Mostly rising until 2020, where there was a special circumstance concerning a company that they spun off, and then rising again, including a big rise in what is labeled on the graph next 12 months. That, of course, means this year, and that includes the profits that they expect to make from the coronavirus vaccine. Overall, without displaying more details, I personally give Pfizer a B on their financials on a scale just like you had at school, A through F. B is a good grade, not the best grade. Pfizer's strong points are its profitability, which we saw, its 10 record profitability, which means not only this year, but going back, we could see that Pfizer's been very profitable very consistently over the last 10 years. Earnings per share, the company is always profitable, and they generate tons of free cash flow. It's free cash flow that allows them to pay the dividend, which is the main reason that we're having this discussion. Finally, I want to talk about Pfizer's valuation. Valuation is a subject that I will pay more attention to than some of the video producers that you will see. In a nutshell, what valuation means is Once you've determined that a company is a good or great company, we want to know if it's selling at a fair price. If you do any shopping at all in your life, you know that prices can go up and down, and stock prices are no exception. All things considered, when it's possible, we would rather buy high quality companies at a bargain price, or at worst a fair price, than at a high price. The market provides those opportunities, and they're pretty easy to find. Value investing sometimes is talked about in a way that makes it seem mysterious. There's nothing mysterious about it. It's simply trying to find good prices on high quality merchandise. In talking about Pfizer's valuation, I'm not going to get into the details. I'll just tell you my methodology. I use 4 different methods of valuing a stock, and then I average them out. My 4 methods for valuing Pfizer end up showing that it's fairly valued right now at around its current price. I come up with a fair value of $36, and with high quality stocks like Pfizer, I'm willing to pay 10% more than the fair value that I calculate. In Pfizer's case, that would mean that its maximum buy price would be $40. Okay, let's summarize Pfizer as a dividend growth stock opportunity. Its positives include its high yield at 4.6%, its good dividend safety score, if you recall, it was 75 out of 100 points from Simply Safe Dividends, very high business quality ratings from independent analysts. They have a good portfolio of blockbuster products, none of which are facing near-term patent cliffs, which is the term used in pharmaceuticals for when the patent runs out. Pfizer also has a strong pipeline of drugs in various stages of development. In the pharma business, those drugs in the pipeline are used eventually to replace the drugs as they fall off of patent. And as we saw, Pfizer has good financials with excellent profitability, cash flow generation, and another thing I didn't mention before, they have been buying back their own shares every year for over a decade. Their share count has been declining steadily, and I like to see that because it means that the annual dividend pool is paid out to fewer shares, meaning that it's easier for them to both maintain their dividend 3 times a year and to raise it once a year. The only real negative I find with Pfizer at this time is its gradual slowing in the rate of dividend growth, but I mostly give the company a pass on that because of its high yield. Getting 4.4% yield on or 4.6% yield on a high quality company like Pfizer is not a common thing, and it is something to seriously consider. And that concludes my first video for dividends and income. I hope you liked it. As I said, please click the like button if you like this content and would like to see more of it. And I'll see you guys again in about a week. Thanks.